Ever wonder how big retailers never seem to run out of stock, or why certain products hit the shelves just in time for the busiest shopping seasons? It's not magic, it's inventory control. By using these systematic techniques, businesses can better manage their inventory levels, reduce associated costs, and enhance service levels. Let's understand more. What is inventory control? Definition. Inventory control refers to the systematic approach used by companies to manage the acquisition, storage, and use of materials or finished products. It involves setting minimum and maximum inventory levels, determining reorder points, and implementing strategies to avoid overstocking or understocking. The goal is to ensure that the right products are available at the right time, while keeping inventory costs as low as possible. Importance of inventory control. Effective inventory control is crucial for several reasons. Cost reduction. By managing inventory efficiently, businesses can minimize storage costs, reduce capital tied up in stock, and avoid overstocking, which can lead to waste. Improved cash flow. Controlling inventory levels ensures that cash is not unnecessarily tied up in excess stock, allowing businesses to invest in other areas. Customer satisfaction. Maintaining the right inventory levels ensures that products are available when customers need them, leading to improved service and satisfaction. Reduced risk. Proper inventory control reduces the risk of stockouts, which can result in lost sales, and overstocking, which can lead to obsolescence or spoilage. Inventory control methods. Before getting into methods, if you want to crack your supply chain and logistics interview, then you can check out the Ultimate Supply Chain Interview Guidebook. It covers all the questions which you face in your interview. So ace your interviews with confidence. Please click on the link or visit our store. 1. ABC Analysis, Always Better Control. ABC analysis categorizes inventory into 3 groups based on the value and importance of items. A. Items, high-value items with low sales volume, e.g., luxury goods. These require tight control and accurate demand forecasting. B. Items, moderate-value items with moderate sales volume. These need moderate control. C. Items, low-value items with high sales volume, e.g., everyday goods. These require less control. Use case, focus on managing the high-value A items more rigorously to improve profitability. 2. VED analysis, vital, essential, desirable. VED analysis is used for categorizing inventory based on criticality, often applied in healthcare, automotive, and machinery industries. Vital, items that are critical for operations, and a shortage would halt production or services, e.g., critical machinery parts. Essential, important but not immediately critical. A shortage would cause some disruption, e.g., intermediate spare parts. Desirable, items that are nice to have but won't impact operations significantly, e.g., non-critical components. Use case, helps prioritize inventory management based on the operational importance of items. 3. FIFO, first in, first out. FIFO ensures that the oldest inventory, first in, is used or sold first. It is most useful for perishable goods or items with expiration dates. Example, in grocery stores, older stock is placed in front, ensuring that it gets sold before it expires. Advantages, reduces the risk of spoilage or obsolescence, particularly in industries dealing with perishable goods. 4. LIFO, last in, first out. LIFO works on the principle that the most recent inventory, last in, is used or sold first. It's often used in industries where prices fluctuate rapidly. Example, in industries where material costs are rising, LIFO can reduce taxable income by selling higher-cost inventory first. Advantages, can help in tax benefits during inflation, though it doesn't reflect the actual flow of goods. 5. EOQ, Economic Order Quantity. EOQ is a mathematical model that calculates the optimal order quantity to minimize total inventory costs, including ordering and holding costs. Formula. Where D equals demand. S equals ordering cost. H equals holding cost. Use case, useful for stable demand environments where the goal is to balance ordering and holding costs. 6. JIT, just in time. JIT focuses on minimizing inventory by ordering goods only when they are needed for production or sale, thus reducing holding costs. Example, an automotive manufacturer only orders parts when they are needed in the assembly line. Advantages: reduces holding costs and waste but requires highly reliable suppliers and accurate demand forecasting. 7. HML analysis, high, medium, low. HML analysis classifies inventory based on unit price. Items are divided into high-cost items, need strict control to avoid overstocking. Medium-cost items, require moderate control. Low-cost items, require less control. Use case, helps in pricing strategy and budget allocation for inventory purchases. 8. SDE analysis, scarce, difficult, easy. SDE analysis classifies inventory based on the ease of procurement. Scarce, items that are hard to source. Difficult, items that require time or special conditions to procure. Easy, readily available items. Use case, useful for managing supply chain risk, focusing more on scarce items to ensure availability. 9. Perpetual inventory system. The perpetual inventory system keeps track of inventory continuously, updating the records automatically after every transaction, sale or purchase. Advantages: provides real-time inventory data, making it easier to avoid stockouts or overstocking. 10. Min-max system. The min-max system sets minimum and maximum levels for inventory. When stock reaches the minimum threshold, new orders are placed to bring stock back to the maximum level. Use case, simple and effective for keeping inventory levels within a specified range. That's all for today. You can watch more inventory-related videos. Till then, keep optimizing.